Hello, my name is Branner and I'm the Chief Investment Officer at abrdn. Let me share with you our latest views. First, what happened in the first half of 2023? Last year, most people found out how uncomfortable it can be when new interest rate regimes works against traditional diversification effects. Unfortunately, a lot of people got it wrong again in the first half of this year because investors have been surprised by how strong the equity markets have been. Despite ongoing interest rate hikes, economists have proved surprisingly resilient, while hopes that artificial intelligence can usher a new dawn added to hopes that central banks could pull off a soft landing. So what's your outlook for the remainder of 2023? Strong household balance sheets continue to provide shelter from higher rates. As such, we think near-term recession risks have declined, which could support equities in the fall, while corporate bonds are also becoming more compelling. But recession risks have not disappeared. We still think it's a matter of when and not if. Central banks have been hawkish in response to this combination of solid growth and stubborn underlying inflation. So expect more interest rate hikes in most developed markets, even if we are approaching the end of this tightening cycle. Where do I see the silver lining? These economic downturns across the major developed market economies, as well as in part of the emerging markets, will lead to a relatively rapid retreat in inflationary pressures, paving the way for deep interest rate cuts through the course of 2024. We differ from the consensus view in terms of how we see the magnitude and pace of interest rate cuts and where interest rates should settle in the medium to long term. So what's our asset allocation house view? Over the shorter term, we're underweight stocks and corporate bonds, and we think markets aren't sufficiently pricing in the risk of a recession. This also largely explains why we're overweight government bonds, since yields offer value over the medium term. We also see value in emerging market local currency debt, given the positive real yields on offer, declining inflation, and room for emerging market central banks to cut interest rates. On the other hand, commercial real estate is still overpriced. It will take time for this market to adjust, and the effects may spill over into other corners of real assets allocation for a while. The diminish of US dollar is a recurring theme in markets, but it continues to be a linchpin of efficient FX markets. We are not taking a strong position on the US dollar. On the one hand, it could rise further if inflation is harder to shake, and it could do well if risk-off surprises markets' expectations of a soft landing. On the other hand, the dollar looks expensive if we take a longer-term view.